Tourist arrivals to South Africa might not be as good as they could be, but there seem to be enough of them to keep Growthpoint's V&A Waterfront complex ticking along. That and its Australian business are helping offset a tepid local property market. And joining me now to discuss the group's first half results is CEO Norbert Sasser. Norbert, thanks very much for coming to studio. Before we went on air, we were talking about how long you've had the Waterfront complex for, so it'll be its 5th year now. Do you thank your lucky stars that you bought it, given the performance of it in this first half?
Yeah, no, absolutely. I think it's it's been a phenomenal investment. It is a capital-hungry asset, though. You're having to spend a lot of capital there and keep it maintained and refresh it and bring new opportunities and new developments. I mean, right now we've got over 3 billion rand of development spend committed, to the waterfront. But it's going from strength to strength. If you look at the trading number, the retailers are all exceptionally happy. Their trading figures are up. I think trading density is up 11%, total turnovers are up 13%, and every year it just keeps doing better. Obviously impacted by the weak rand, as you said, with tourism. But it's a truly phenomenal asset.
I mean, how much more would you have to put into the waterfront to develop it? Because there was always a huge development area that you bought when you actually bought the existing operation. Correct. So how much further does it have to run, I suppose? So
of the 200,000 square meters of bulk that we had available, I think with what's currently underway and what's already sort of pre-committed, we would have used about 70,000 of the 200, leaving another 130,000. So if you do some, rough math, you probably got another, I would say, 7 to 10 billion rand worth of future development capital spend to take place at the waterfront to build out the current rights that are there. Okay, but for this year, how much capex is committed? So this year we spent, our share was about 266 million, and remember we half, so the PIC did their 266, so it's 520 odd million this year, and we've got another commitment for the next sort of 12, 18 months of 1.5 billion between the two of us, so just over 700 each. So as I suggested in my introduction, it's the V&A Waterfront, which is, I suppose, your flagship asset, and also your Australian properties, which are helping offset very difficult economic circumstances in South Africa. But if we look at the vacancy rates across the business, they have come down, and not just in Australia, but in South Africa too. I mean, how is that a sign of health, or is it just fighting really hard to bring those vacancies down? No, it's certainly the latter. So, I mean, I think there are a couple of what I call the fundamentals that are looking pretty good, and very stable. So vacancies, in fact, as you mentioned, have come down at below 5% right now, 4.9. I think at the year end in June it was sitting at about 5.7, and at the comparable period in December 14 we were sitting at 6.4. So it has come down. Arrears are very stable. Our arrears book is at low levels. Our bad debt charge to the income statement, something like 7 million for the half year, which is very low. Our cost and our cost to income ratios are in control. So some of those are stable and under control. But when you translate it into rental growth, and that's where the problem sort of starts, because you're having to spend money to either acquire new tenants, i.e. convince them to come into your portfolio, or if they're already there, you're on the defensive here, because it's a very competitive market out there, and you're having to provide incentivization in the form of either rent-free or in the form of tenant installation allowances, whatever shape it might take, as well as rent reductions in rentals, in certain instances, to keep them in the premises. So what does that suggest then for the prospects for Growthpoint in the next, say, 6 to 18 months? Is it going to be more subdued in the kind of distribution growth that you would be giving to your shareholders? Will that also be more subdued? Correct. So, I mean, we've come out of a sort of a 7 to 8% distribution growth year over the last couple of years. This year we guided for 5 to 6%. In fact, we've come out at the higher end of that guidance range. We maintaining, our forecast for the year. This is half year, so for the year to June 16, we're maintaining that outlook that we would be looking for 6% growth this year. Beyond that, we're in the budget process right now. It's sort of difficult to tell. I think one of the issues which has hampered us a bit this year was the take on of EcuCap and SciComm last year. Very big acquisition, over 12 billion rands worth of assets, and in fact much more. It's probably over 18 billion rands worth of assets, and bedding that down, integrating that, all of that comes at a cost. and hopefully we can set a new base, in the June 16 numbers, and look to slightly improved growth beyond that.
No, but it's been interesting that most of your acquisitions, aside from the Australian operations, where you did make acquisitions over the period, have been in South Africa. If you look at what's happening to the other property companies in South Africa, Redefine, for example, yesterday announcing a really big acquisition in Poland, and Mark Wayner was saying, they just don't see much opportunity in South Africa. They're seeing opportunity more abroad. You haven't really been, it seems, tempted overseas. I mean, was that a deliberate decision, or are you going to start looking for overseas assets?
So look, I think what you're going to understand is that this particular set of numbers now for the half year to December includes the impact of AccuCap and SciComm for it's the first full 6-month period that they're in our numbers. That deal was probably done in 2014 and implemented in April 2015. So it's more than almost a year ago that deal was done, and in the interim since then, if you look at the numbers and the results for the period, we've actually sold more properties in South Africa than we've actually purchased. In fact, we spent more in the Australian subsidiary. I think the acquisitions there was 1.3 billion rands worth of acquisitions in Australia, and obviously we kept supporting that. So it's fair to say that the investment parameters and dynamics in South Africa at the moment are not great. You've got negative yield spread. It's costing you 9.5% to borrow 5-year money, and you're not getting that kind of yield on purchases. So we haven't, the AccuCap SciComm deal was a corporate action kind of transaction, and as I said, almost more than a year ago. I'd say we are tempted, by the offshore opportunities. What we are busy, I guess, trying to get to the bottom of is just what is that opportunity. We're a bit concerned that it is a very one-dimensional financial play and not really a property play. And when I say that, what I mean is property globally, certainly in Europe and in the UK, wherever you might look, probably as expensive as it's ever been, other than prior to the financial crisis of 2007, 2008. What's creating opportunity is just very cheap, ridiculously cheap debt. Now, what happens when that changes, that dynamic changes? So you're buying very expensive property with very cheap debt, and the property value can only go so far, but certainly the debt can reprice upward quite quickly. And also growth. Growth in Europe is very questionable. It's all good and well to lock in this initial profit or this initial yield spread, but beyond that you have to grow. And so we're working through it. We've got one eye out there on Europe and the opportunities, but we haven't found anything that works for us yet.
Just very quickly, Norbert, you talk about the debts that you take on in South Africa at 9%. Is there any way of bringing the cost of that debt down, or is that likely to be the situation for the
if anything, it's getting
future?
worse. I mean, Juliet, you know that I guess it's consensus out there that short-term interest rates are probably set to rise between 75 basis points and 1%. So prime at currently 10.25, you're looking at prime at 11 by year end. The swap curve, is already reset. Long bond rates are higher. Margins from the banks. So the banks are still lending and very keen to lend, but they're pricing it more expensively. The bond market's not really functioning properly at the moment, so you don't have the ability to play the banks off against the bond market and vice versa. So if anything, interest costs are going to continue to rise.
Yeah. Well, unfortunately, we have to leave it there, but hopefully we'll chat to you maybe before your year-end results. Norbert, thanks very much for your time.
Thanks, Juliet.
Norbert Sasse is the CEO of Growthpoint Properties.